It's a cash and stock deal worth about $72 billion at present. It will create the first coast-to-coast freight operator in the country, the #1 deal the rail industry has seen in terms of its size.
Think investing in 2025 is all about AI and trending tech? Then picture this. An 1860s locomotive pops into your newsfeed with an $85 billion surprise. Union Pacific and Norfolk Southern just pulled off the investment story of the year. This video shows why these old-school giants could be your smartest move for 2025. You may already own Union Pacific or Norfolk Southern stock. You might be looking to add stable logistics names. Or maybe you just want to understand the bigger economic picture. In either case, stick around until Chapter 4. You'll not only learn whether to buy or sell, but also how this deal could affect other major companies, from rival railroads to delivery giants. So buckle up, all aboard, and see why a seemingly boring industry might transform your portfolio. Welcome back to the club. Before we begin talking about the merger, let's look at the company's histories and why it matters now. Union Pacific began in 1862. It built the portion of the first transcontinental railroad, stretching westward from Omaha, Nebraska, to meet the Central Pacific at Promontory, Utah. In 1869, it met the Central Pacific at Promontory, uniting the nation by rail. A scandal and a financial crash pushed it into bankruptcy, but Edward H. Harriman modernized operations and brought it back to life. Today, Union Pacific remains the largest railroad in the western U.S. It runs over 30,000 miles of track across 23 states. It hauls coal, automobiles, grains, and chemicals. The company generates around $24 billion in annual revenue and has a market cap of roughly $136 billion. Despite that strength, growth has slowed, and competition from trucking has intensified. By merging with Norfolk Southern, Union Pacific hopes to create a coast-to-coast network, recapture freight lost to trucks, and unlock billions in synergies. This resilience and forward thinking is why understanding Union Pacific's past and present is crucial to seeing where it goes next. Union Pacific's story sets the stage, but the other player has an equally compelling journey. Now that you know Union Pacific's story, let's turn east and explore Norfolk Southern. Norfolk Southern formed in 1982 from Southern Railway in Norfolk and Western. Deregulation let it prune unprofitable lines and invest in key corridors. It operates about 19,000 miles of track across 22 states. It is one of only 2 major freight railroads in the eastern U.S., alongside CSX. The company moves coal, automotive parts, industrial products, and intermodal containers. Its network connects ports on the Atlantic and Gulf coasts to the industrial Midwest. The Crescent Corridor is a high-speed route linking New Jersey to New Orleans, making the railroad vital for intermodal traffic. Norfolk Southern's annual revenue is around $12 billion. In the second quarter of 2025, it reported roughly $3.1 billion in revenue, with net income up 4% and earnings per share up 5%. These numbers show it's profitable, despite recent challenges. However, the company stumbled in 2023 when a train derailed in East Palestine, Ohio. The derailment cost over $1 billion and led to a leadership shakeup. Activist investors gained board seats and replaced the CEO. Norfolk Southern has since invested in safety programs and new track inspection technology. This episode shows how quickly fortunes can change, even for a stable and essential freight network. Now that we understand both companies, let's see what happens when they join forces. In July 2025, Union Pacific offered to buy Norfolk Southern for about $85 billion. Norfolk Southern shareholders would get 1 Union Pacific share and $88.82 in cash per share. That values each Norfolk share around $320, roughly a 25% premium over its share price on July 30th. The combined network would cover more than 50,000 miles across 43 states. Management promises $2.75 billion in annual synergies. This number represents about 4 to 5% of the combined revenue, a sizable boost in efficiency. TD Cowen analysts see free cash flow growth of 60% by year 3 and rate the stock a buy Others say hold, with a $275 target, pointing to regulatory and integration risks. Approval could take 2 years. Unions and some customers worry about safety and competition. If regulators block or alter the deal, the benefits could shrink. So, what should an investor make of all this? Now let's wrap up with advice tailored to 3 types of investors and how the merger could affect other players. If you already own Union Pacific shares, you have exposure to a strong railroad that has performed well for decades. The merger could add growth by opening a coast-to-coast network and boosting free cash flow. But it also introduces regulatory risk. You don't need to make big changes now. If you are comfortable with long-term uncertainty, you can hold your shares and watch the process unfold. Keep an eye on how regulators and the market respond to the merger news. As a Norfolk Southern shareholder, you are at the center of this deal. The offer values your shares at roughly $320 and gives you part of the combined company plus a cash payout. If the merger is approved, you may see significant upside and end up owning a stake in a coast-to-coast railroad. If regulators block or delay the deal, the share price could drop, and you'd be left with a company still dealing with legal challenges and slower growth. Your decision to hold or sell may depend on your risk tolerance and time horizon. Many analysts recommend patience if you believe in the long-term benefits. If you're new and considering investing because of this merger, approach with care. The deal promises big synergies and a historic coast-to-coast network, but it's uncertain and could take years to finalize. You could buy Norfolk Southern shares to potentially benefit from the premium, but you must be ready to wait and accept the risk of a failed merger. Alternatively, you might choose Union Pacific for its existing scale and stability without tying up capital in a long approval process. Another strategy is to sit on the sidelines until there's more clarity. Choose whichever approach aligns with your risk tolerance, time horizon, and overall investing plan. Finally, remember that this merger could influence more than just these 2 companies. Other freight railroads, such as BNSF, owned by Berkshire Hathaway, and CSX, may feel pressure to consolidate in response. Canadian carriers like Canadian National and CPKC could adjust their strategies too. Large shippers, including UPS, FedEx, Amazon, and auto manufacturers, might shift freight from trucks to rails if coast-to-coast service becomes faster and more reliable. All of these factors could create new opportunities or risks across the supply chain. To decide if this merger is sound, consider 4 perspectives. First, strategic rationale. A united network from coast to coast could eliminate costly handoffs. It could speed up transit times and recapture freight lost to trucking. Next, financial perspective. The 25% premium is typical for a major deal. Management forecasts $2.75 billion in annual synergies. Free cash flow growth is expected to be 60% by year 3. Still, the combined company will carry more debt and integration costs. Third, regulatory perspective. The Surface Transportation Board must approve the merger. It hasn't okayed a large rail merger in decades. Approval could take 2 years. Regulators may impose strict conditions or block the deal altogether. Fourth, labor and safety perspective. Unions and communities worry that cutting costs could undermine safety. Norfolk Southern is still recovering from a costly derailment. Union Pacific has faced its own safety critiques. Taking all of these into account can help you decide if the merger looks like a sensible long-term investment. In all cases, investing is like building a railroad, slow, steady, and focused on the horizon. We've seen how long-term thinking and resilience can turn a 160-year-old railroad story into a modern investment opportunity. But what happens when markets suddenly derail? The patience we just discussed is only part of the puzzle. In one of our previous videos, we reveal the one rule that helped investors reduce their losses by 16.62% during a major market crash. Just as railroads have to weather storms and still reach their destination, This rule helps you stay on track when volatility strikes, whether it's because of tariffs, rate hikes, or even massive mergers like the one we explored today. Click to see how to apply the same calm mindset to protect your portfolio. And if you appreciate this kind of thoughtful analysis, subscribe for more weekly finance insights. Thank you for watching, and see you in the next one.